guys, welcome back to the channel. If you remember a couple of weeks ago when we were hovering around this area, I said to expect a bounce, which happened, and then the following update, which was last week, I expected that we would see a reversal here, which also happened, and I thought we'd probably continue down. We haven't done that yet, but as you can see, that's still on the cards, so this could be easily viewed as simply a 1, 2, and with a third wave to come. So we remain bearish and waiting to see what happens. After the CPI report came out, we did initially get a bit of a dump and then a bounce quickly afterwards. And I think what happened there was that we got a bit of a short squeeze. So not all short squeezes are created equal. Obviously, this is nothing like the GameStop short squeeze, but it's important to understand how a short squeeze works. So I'll just quickly explain how a short squeeze works. Let's say, I'll just draw something here. Let's say we've got two sides of the coin here. We've got the longs and we've got the shorts. And let's say that we've got all these people over here who are short. Okay, and let's say that makes up 99% of traders are short. And now we have just a few traders who come over here and decide to go long. So what's actually happening here is you've got all these people who are short. They've already entered their positions. They are no longer a factor in what pushes the market up or down, because it's buys and sells that pushes the market up and down, not people holding their position. So these people are all holding position. The only way that they can now affect the market is if they either add to their position, which isn't that common, or their stops get triggered, stops and liquidations. So now you've got most of the people who are already short. It only takes a few people to go long. There's no resistance there to stop the market from pumping. So a couple of people, well, when I say a couple of people, in reality it would be thousands of people or whatever, but a small percentage of the trading community has now decided to go long and bet against the herd, which are short. And what happens is it doesn't take much to push the price up, and that then starts to trigger all of the stop losses and the liquidations over on the shorts, which sends the price higher. And obviously, like I said, all short squeezes aren't created equal. This is nothing like a GameStop short squeeze. There's just a little short squeeze here that happened straight after that CPI data. And I think that what happened is probably like me, a lot of traders were looking at the previous one where there was a big dump straight afterwards and expecting the same thing to happen. And therefore, most people were short and led to a bit of a short squeeze. But I don't think that this rally is going to continue. And I just want to have a look at the last statement from the recent FOMC meeting. And they said here, I've highlighted it for you, the committee is strongly committed to returning inflation to its 2% objective. So with the inflation coming out at 9.1%, they've got a long way to go to get it down to 2%. So I think a lot of people are saying, oh, well, look, the price of oil's coming down. That means inflation has probably peaked. And that might be true, but it doesn't mean that the Fed is going to stop unwinding its balance sheet. That doesn't mean that the Fed is going to stop raising interest rates. And those are the things that pushes the price of risk assets down. So until we get to 2%, that's the story at the moment anyway. Until we get to 2%, the interest rates are going to keep going up. They're going to keep pulling liquidity out of the market, and that's not good for Bitcoin and risk assets, which is why I say that this is probably a fool's rally. So what we've had here is we've had an impulse move down, and this is more corrective. And let's just delve into Elliott wave theory a little bit. I'm not going to get too much into it, but basically, if you simplify Elliott wave theory, it is all about impulse moves and then corrective moves. So an impulse move is pretty obviously defined by its angle, almost straight down or very steep. Okay, we've got one impulse move there, we've got an impulse move here, and then these moves here are more corrective. So we've got this one here is more corrective, this one is corrective, and this one is corrective. And you can tell they're corrective because they're shallow. So impulse correction, impulse correction, impulse correction, and the trend is in the direction of the impulse moves. And that is really Elliott wave theory in a nutshell. And you can get a lot from just understanding this and not even having to count the wave patterns. But if we were to count this wave pattern, it would probably look something like this. This would be the third wave. The third wave is always the most impulsive. So 3, and that could be 4, 5. Or if we were to go down to a lower time frame, let's get onto the 4-hour time frame here. This is a triangle shape. Here, triangles always appear in the fourth wave. Draw that in, something like this. So 3, 4, or 4 at the end here, and then 5. So 5 terminating down here. Let's jump back onto the daily now. We then have a B, C correction. Let me just draw that on there for you. A, B, C, and I'm not using the right colors or whatever, I can't be bothered. And then this is quite likely to be a 1, 2. So the end of the correction there, and then 1, 2, and then 3 may pump down here somewhere. We're not too sure at this stage. Let's put the 4 and 5 over there. And so that's how I'd be viewing it at this stage, is this being a 1, 2, and that will be invalidated if it passes here in line with the Elliott wave rules. Number 2 can't go past the beginning of wave 1, which is here. So if price goes above here, even a wick above here, that would invalidate this analysis. But until we see that happen, I'm going to be viewing this as a 1, 2 and expect an impulse move to the downside. And if we were to break above that, then we can start considering something else. I'll just get rid of that. Let's get rid of this, and let's get rid of those numbers. If we were to break out of this parallel channel, because the ABC corrections are usually confined within parallel channels, if we were to break up above here, then we can start looking at it as this is maybe a 1, 2. Let's get rid of those, and then, well, 3 may come up here somewhere. So until proven otherwise, I think it's the other way around. I think it's 1, 2. If it breaks above here, we can think of this as 1, 2 and a third wave beginning, which I think would probably get shot down around about here, because ultimately I think that because of what the Fed is doing, the market's just going to keep going down. Even if it does have some good bear market rallies, don't fight the Fed. Cheers guys, I'll see you in the next video.